Hello everyone and welcome back to the channel. My name is Sean and this is We Are Investing, a channel that's dedicated in investing and personal finance. On today's video, we're going to dive into the most recent inflation report, the Consumer Price Index, also known as CPI. Now this is for the month of March, being released in April today. And the initial market reaction following this print was a positive one. But at the end of the day, all major indices ended negative, in the red. Why is that? Why did the market behave in such a way? What did this data tell us in regards to inflation and what the Federal Reserve might be doing moving forward? So let's talk about it. Let's get into it. Now, if you're new to this channel, definitely consider hitting that subscribe button and ringing that notification bell. YouTube will notify you when I upload more videos, and it helps with the growth of the channel. And if you want to support the channel even more, you can do so by joining the Patreon. It gives you access to a private Discord server where we have live trade alerts. It's super cheap, only $5 a month. A link is provided down below. Now, the CPI report for the month of March showed headline CPI at 5% year over year, which was a nice decline from the prior month that showed CPI at 6%, headline CPI at 6%. And it was also below expectations of around 5.1 to 5.2% for headline CPI. Now, headline CPI is the inflation for all goods and services that are included in the Consumer Price Index. We also have to take a look at core CPI, which excludes prices for very volatile stuff that the Federal Reserve cannot control. Gas and groceries, gas and food, energy and food. Now, core CPI came in at 5.6% year over year, which met expectations, but was also a 10 basis point increase from the prior month when it was at 5.5%. Core CPI is what the Federal Reserve looks at more closely because it excludes the items they cannot control with raising the federal fund rate. So seeing a core CPI that is still going up month over month and is still sticky coming in at 5.6% isn't good for the Federal Reserve's outlook on inflation and how they are doing right now. And that's probably why we saw the indices actually start to fall during the day, because of that sticky core CPI. Now, this data didn't really change too much when it comes to the CME Fed Watch tool, which is now pricing in a 74% chance that the Federal Reserve will increase the Fed funds rate by 25 basis points the next FOMC meeting. Meanwhile, we also got news from the San Francisco Fed President, Mary Daly, which she said in a prepared speech that the central bank may have to tighten policy further due to persistently high inflation and a still strong economy. Another Fed president, Barkin, said in an interview with broadcaster CNBC of the report, "I put particular focus on the core, which is still running a little over 5% year over year. And you know, we had some good news on energy, but there's still more to do. I think to get core inflation back down to where we'd like to be." Barkin declined to say in this interview whether he supported another rate hike at the Fed's upcoming policy meeting on May 2nd and 3rd, but emphasized that while demand is cooling, he is also very alert to jobs and inflation data, both of which remain relatively robust. Listening to that interview, I get the feeling that the Federal Reserve is going to continue to increase rates. He said that he's waiting for inflation to crack. It's moving in the right direction, but in the absence of a month or 2 months or 3 months with inflation at our target, it's hard to make the case that we're compellingly heading there, Barkin said. Now, if we head to the Discord and we take a look at the CPI chart, and this is going to show us the 12-month percent change for all the categories in the CPI. We're not going to dive into the items under each category, but we are going to look at every single category and see how it is increasing year over year. So food right now 8.5%. Now, food is not core CPI, but 8.5% on food alone is not good for the way people want to feel about the economy. It will impact consumer spend on discretionary goods. In addition to that, what's the big change here and what is helping headline CPI come in low is energy, which came in at negative 6.4%, with energy commodities coming in at negative 17%, gasoline coming in at negative 17.4%. So crude oil and gas definitely helped bring that headline CPI down. Keep that in mind because we are going to circle back on this because it's very important based on what crude oil is doing today and the implications that can have moving forward with CPI. We also have, let's go on to some of the other categories here. If we look at shelter, which is rent, housing, another very important sector for consumers, that is at 8.2% increase year over year. Medical care services 1%, and transportation services 13.9%. The only other thing that really is coming down besides energy is used cars and trucks, which came in at negative 11.2%, but has bottomed and is starting to rebound. Now, I wanted to talk about oil again because if oil was to rebound and start moving higher, that means that CPI is going to have a tougher time coming lower. And that means that it's going to take more time and more rate hikes from the Federal Reserve to get it back down to their target of 2%. Now today, WTI, which is crude oil basically in the States, climbed above $83 a barrel. And according to an article, this was bolstered by a broader relief rally triggered by signs of moderating U.S. inflation. Russian shipments slid below 3 million barrels a day for the first time in 8 weeks after Moscow vowed to cut production. And in the U.S., oil inventories at the key crushing Oklahoma storage hub slid for a 6-week to hover near the lowest since January. Now, if you've been following this channel, you know a couple days ago we uploaded a video on why we are bullish on oil futures. And now what I want to show you is the chart for WTI. If we look at this daily chart, you can see that I have a range that is basically surrounded by those two green horizontal bars. That was the range. We dropped below it when we saw those banks fail and the Federal Reserve and the Biden administration did not come in and refill the SPR. That is why we got OPEC Plus with that surprise cut to try to stabilize the prices of crude oil. We saw that initial pop following that cut in production, which is that gap right here. Following that gap, we had a couple trading days of consolidation. But today, we broke out with a very bullish candle and we broke above the resistance. In addition, when you combine this with all of the other stuff that we mentioned, oil is looking very bullish and we could get back up above $90 a barrel. On a prior video, we talked about analysts calling for close to $100 in crude oil, Brent crude oil, by year end. WTI is less than Brent crude. If we look at Brent, we're trading at $87 currently. So there's still room for Brent and WTI to move higher. This most recent bounce will impact inflation, headline inflation, because energy prices are not going to continue to go down. They are going to rebound a little bit. And if we continue to see food being at around 8%, very sticky, rent, same thing, very sticky, and other goods and services being sticky, inflation is going to be extremely tough to bring down to 2%. And this combined with slowing economic growth, a recession, is what we're talking about with stagflation. And this is why I believe gold futures have gone from around $1,600 to above $2,000 and are very close to hitting their all-time highs and potentially breaking out. Because like we mentioned in that prior video, gold typically outperforms during stagflation, and we could break that prior all-time high of $2,089. So after this print was released, the initial reaction from the market and from the news media was that it was extremely bullish. But after we do our own research and we dive into the numbers, and the price action from today alone shows that the market might already had a lot of this priced in, and it's not as bullish as they are reporting. And when we take a look at the market, we see risk to the downside with limited potential to the upside, which means it's not a favorable time, in my personal opinion, to start entering into long positions. But as always, guys, this is a story that is always evolving and things can change like that. So definitely do yourself a favor and follow this channel so that you stay on top of market news and market analysis. In addition, comment down below to help drive engagement. What did you think about this CPI report? Do you think inflation is going to continue to come down at a good rate and the Fed should stop raising rates? Or do you think the opposite of that? Let us know down below in the comment section. I thank you so much for your time. That wraps it up for this video. My name is Sean. This is We Are Investing. It's been real. It's been fun. It's been real fun. And I'll catch you on the next video. See ya.